rate, but we're looking at how kind of currency differentials work. That is a mechanism that they can turn to, and other countries often turn to. The U.S. doesn't, one would think, because the deficit is mostly interest rate insensitive, and if anything, higher rates increase the deficit. And so that's
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.
current structure of the dollar system, prolonging the strength of the dollar actually has some disadvantages. The way that it currently works, in order to maintain this big saleable currency that the whole world uses, it means the whole world, they all demand dollars, so they all have to get dollars. And how do they get dollars? For the most part, the U.S. runs a structural trade deficit and pours dollars out into the world. And a lot of that is self-correcting in the sense that because the whole world needs dollars, there's a lot of demand for dollars above and beyond normal things that currencies trade on, which is like interest rate differentials, trade balances, things like that. So in addition to all those forces, the dollar has this extra layer of demand that other currencies don't have, and which sounds great, except for the fact that the cost of that is that basically the dollar is perpetually overvalued based on a lot of these things. And so our import power is really strong. Our export power for lower margin goods is fairly weak. And when you run that playbook for decades, and a lot of it is like a self-reinforcing playbook, then the downsides of that start to become politically front and center. So the reshoring case, Bitcoin. And so a lot of, when you see a lot of countries with these really big current account surpluses like Singapore or Switzerland, or say the UAE that's pegging their currency but is running a big current account surplus, often they'll suppress their currency from getting stronger by printing their currency to buy a bunch of foreign reserves. So instead of the accumulated surpluses strengthening their whole currency base, it instead accumulates basically at the sovereign level. The downside of that is that the workers there don't get as much of the benefit of the surpluses that they're getting. And a lot of that accumulates at the sovereign level. So if you take it from an anti-statist argument, that's not great. But we're looking at how kind of currency differentials work. That is a mechanism that they can turn to, and other countries often turn to. The U.S. doesn't. And that starts to kind of work itself into the system. Then the U.S. is well positioned with a really big chunk of that. So, people often ask me, like, should the U.S. do it? It depends who you're at. Like, on one standpoint, I want sovereigns to accumulate it last and have people accumulate it first. But I would rephrase that to say, whoever I'm advising, the answer is yes, you should accumulate Bitcoin. If you're trying to maximize the thing that you're advising, whether it's a family, whether it's a company, whether it's a sovereign, the answer is yes, try to accumulate Bitcoin and hold it for decades, because that will affect your balance sheet and your future value. Literally, whether you're a company, family, or in this case, a whole country for which the balance sheet does matter. Like, part of what makes, say, Singapore attractive to invest in is that they have a ton of reserves that they could use to defend their currency should they need to. And there's lots of other countries like that. So that's certainly a variable that matters in terms of, currency long-term. Now, there was a deficit overlaid on top of that, but that was a smaller factor. And then, of course, there were factors like oil shortages that would actually translate that into, instead of just going to asset prices, it would actually go to consumer price increases. But basically, you had above target money supply growth during that period, and the majority of it was from money supply growth. And at the late stage of the 70s, early 80s, the federal debt to GDP was something like 30%, which is historically low. And so when the Fed comes in and sees this situation, when Volcker comes in, they say, well, if we jack up interest rates super high, we will slow down borrowing demand, slow down overall, fractional reserve bank money creation, and that should contain inflation. Now, as a side effect of that, it will increase the deficit because it will increase interest expense, one would think, because the deficit is mostly interest rate insensitive. And if anything, higher rates increase the deficit. And so that's why almost all the Fed's tools are based around either controlling the speed of bank lending or affecting interest rate, like currency differentials with other countries. And they still have the second one, like, making the dollar attractive versus other currencies, so you don't get like a capital flight. But their ability to kind of, affect bank lending is like they're only affecting the second or third smallest, like the second or third biggest variable in money supply growth. They're no longer affecting the biggest one, which is deficits. So that's kind of what it means to be stuck in fiscal dominance.
And they're actually making it worse, right?
Yeah.
They're making the number one thing worse when they raise the interest rates. The interest expense just blows out. So the interest expense was larger than the defense spending for the first time, right?
And if you're Google, like if you're one of these major Mag 7, especially the ones that are really profitable, they've got a huge like cash equivalent hoard, and then pretty low debt, or whatever debt they do have is like Apple, like locked in at like low fixed rates. So anytime you increase interest rates, you give them a raise, and then they can plow into more share buybacks. And so you're only really slowing down like the most vulnerable part of the economy. So you're kind of, around the margin, it is tampering inflation, but it's also blowing out inflation in other areas. By extension, kind of the kind of the cruelest thing that the Fed can do indirectly is make it another country's problem. So kind of the dark side of Volcker and the whole kind of 70s, 80s era was we jack up the dollar, we basically bankrupt Latin America because they all had dollar-denominated debts. And if you look at their oil, it is actually fairly recent. Like the Fed adopted it in like 2012 or something, and it kind of stretches back to like New Zealand's decision in like the 90s to define it. So it's like a fairly like recent phenomenon. And then there's different interpretations, like is 2% the ceiling, or is 2% a symmetric target, where if you're under 2%, like we have all these ironic quotes now from the 2010s of central bankers saying inflation's too low, we want to get higher. And it's like, well, you got quite a lot of that, in the years that followed. And so they're sometimes able to like change their definition, or they say, well, now we want a symmetric target around 2%. And then, they can move the goalpost by saying, well, we want to get back down to 2%, but these things take time. And it's like, well, they're not projecting it to get there by the end of 2025. So it's like, when exactly are you projecting it to get down to your target? And Powell's also said at one point that oil spikes are kind of outside of their purview, which is correct. So should there be some sort of later like energy related thing that makes inflation sticky, they can kind of define that as outside of their framework, which I would do too, because it's not the central banker's job to make sure energy is flowing. And then they can only slow down demand so much to try to, fight that. And then the only thing about the fiscal comments with Powell is that policymakers will often say that something's unsustainable, but it's kind of like another way of saying it's not their current problem. And what I haven't heard is Powell link the fiscal to inflation enough, or at least as an ongoing concern, to basically say that not like sustainable in the sense that like, our quote unquote kids and grandkids are going to pay for it, but like unsustainable as in I'm trying to reach the 2% target on my watch, and this is the most actively like difficult variable for me to do that right now. That's the part that I haven't really seen him vocal about. And in the future, you could add it is that the downside of the report and the downside of the whole nothing stops this train thesis that I've been hammering is that this is a far harder problem to fix than almost anyone thinks. Multiple layers of challenges, a whole Gordian knot that's extremely difficult to unravel in any administration, let alone 2 or 3 administrations. The upside is that I also don't expect doom anytime soon, in the sense that the U.S. currency just goes completely haywire and collapses, or you get complete blowout in just the whole financial system kind of is in shambles within that time frame either, because the structural stuff is kind of geared toward running hot, but not running into like doom in that time frame. another way I would describe it is that before you go into doom, you got to go through emerging market phase, right? And the U.S. isn't even in an emerging market phase yet.
And so you should expect currency debasement, increase of the money supply, more asset price inflation, all those things that we talked about. You should just expect that to continue, and the economy might run hot. And so in that situation, obviously Bitcoin, hard assets, real estate, equities, I think will all kind of perform well, at least sectors of the equity market. And people need to really protect themselves. And, I think other nations have it a lot harder. I mean, Lyn mentioned the UK gilt crisis, but also the ECB. I mean, what's going on right now, even they have this like instrument called a TPI that they announced in 2022. And it's because they're trying to fight inflation and trying to raise interest rates, but all of these countries have different levels of debt and they're also blowing out their deficits. And it's just like the early 2010s where you had the Greek financial crisis, the debt crisis. But now it's
T-bill is getting a little bit more. And you have to compare that to like the structural growth rate of the dollar supply, or all monetary aggregates. So dollars plus, say, treasuries, for example. You can map it in multiple ways. And you always ask, is my share of the network, if I just hold, so factoring out my new income, because we're just talking about investing or saving, what percentage of the network do I have now? And in 5 years, will I have like less of the network just by holding and collecting any sort of payments I might be owed versus not? And so if you hold dollars and the money supply grows 7% a year and you get paid 4% a year, you're going to end up with a smaller share of the dollar network over a given 5-year period. And same thing with true as gold, except your debasement rate is something like 1.5% per year. But then you also have to ask, is the thing you're holding increasing its like market share compared to other things? So for example, someone could hold IBM stock. You have like 9 board of directors, and like 4 of them like Bitcoin. It doesn't really matter till you hit 5, unless the CEO or the one with disproportional voting rights is the one that gets it. So if it's Fidelity or MicroStrategy, you can be super early because it's top down, whereas bottom up inherently takes a long time. But then it's like gradually and then suddenly. And I still think it's going to be a minority of companies this cycle that do it out of course, the thousands that exist. But they are popping up more frequently now. I think the accounting changes were a big deal. I think another thing is just seeing another cycle. So a point that I made before is that when someone sees like 3 cycles, not that there's been 3 cycles, but that they've seen 3 cycles, that actually matters. And for a lot of people, the first cycle they saw was 2017. And then, because most people have not